Are you looking to boost returns by taking on more risk in your investment portfolio? You may wonder why anyone would want to do that. After all, isn't the goal to minimize risk and maximize returns? Well, yes and no. You see, legendary investors like Warren Buffett and Peter Lynch have expressed interesting views on this topic. Buffett once pointed out that while diversification is generally a good strategy, it can limit your potential for higher returns. He suggested that if you're good at picking quality businesses at reasonable prices, you might do better. Similarly, Lynch advised investors to buy what they know. This philosophy has been proven time and again with individual stocks like Apple, Amazon, and Microsoft, among others. These stocks have offered returns far superior to the market index. But this approach does come with its challenges. The main one being, how do you balance the potential for higher returns with the increased risk? But the question is, how can you incorporate this approach without overdoing the risk? The idea of diversifying your investments is like putting all your eggs in different baskets. But what if one basket could yield more? Welcome to the world of diversification and concentration, a dilemma that has puzzled investors for decades. Many investors are content with a well-diversified portfolio, the core of which is often constructed with index funds. Broad index funds like SPY, VTI, or QQQ and BND can be used to create a 70-30 allocation, a strategy that many investment companies and advisors recommend. And just like that, you're done, right? Well, not quite. There's a flip side to this coin. Famed investors like Warren Buffett have hinted that while diversification is good, you could potentially do better if you're adept at choosing strong businesses at reasonable prices. Peter Lynch, in his book One Up on Wall Street, advised to buy what you know. And it's been proven time and again that a wise investment, often the antithesis of diversification, could significantly boost returns. This means concentrating your portfolio on a few select stocks. Take, for instance, the returns on companies like Apple, Amazon, and Tesla. These were easily identified by individuals who then saw returns far superior to the index. This presents an intriguing approach, dividing your portfolio into two parts. The first part, making up 80% of your total wealth, remains your core portfolio, where you apply index investing. Yet the remaining 20% of your total assets could be allocated to individual stock holdings. Within this 20%, you could select 5 individual stocks. This way, you maintain a level of diversification, but with a focus on specific stocks that could give your overall returns a boost. Yes, this does add risk, but it complements the lower risk and diversified core holdings of index funds. So you're accepting the market return or market risk of indexing, while also taking a measured risk with a portion of your total net worth. This presents a twofold approach, accepting the market return or market risk of indexing, yet taking a measured risk with a portion of your total net worth. So how do you strike a balance between these two approaches? The answer lies in dividing your portfolio into two parts. Imagine your portfolio as a pie. 80% of this pie, your core portfolio, should be built on the solid foundation of index investing. This is where broad index funds like SPY, VTI, QQQ, and BND come into play. They provide a wide exposure to the market, offering a level of diversification that's hard to beat. This core portfolio is your safety net. It's the steady, reliable part of your investment strategy that absorbs market shocks and delivers consistent, long-term returns. None of those broad indexes will go to zero or usually take more of a loss in any one year, greater than 30 to 40%, and would typically recover in a few years, and if you hold some portion in bonds, the total drawdown would likely be even less. Now let's talk about the remaining 20%. This is where you can let your inner Warren Buffett shine and take calculated risks by investing in individual stocks. But remember, it's not about gambling on the next big thing. It's about choosing good businesses at a reasonable price. As Peter Lynch famously advised, buy what you know. This 20% of your portfolio is your opportunity to outperform the market. Companies like Apple, Amazon, Microsoft, United Health, Home Depot, Coca-Cola, Pepsi, Clorox, Netflix, Tesla, and Ulta Beauty have all been golden opportunities that individual investors have identified and capitalized on in the past. But here's the catch. Within this 20%, you should ideally pick only 5 individual stocks. Why 5? Because it offers a sweet spot between diversification and concentration. It allows you to focus on a few promising stocks, yet keeps your risk spread out. This means that even if one of your picks doesn't perform as expected, your overall portfolio doesn't take a significant hit. And don't forget that the 5 stocks should be in 5 different industries to avoid overlap, so don't just pick 5 technology stocks. This approach of dividing your portfolio into a core and individual stocks offers a measured balance between accepting the market return and seeking to outperform it. It allows you to take on more risk, but in a controlled and calculated way. This way, you're not putting all your eggs in one basket, but you're also not spreading them too thin. And above all, it enables you to boost the risk-to-reward profile of your overall investment strategy, while still maintaining a core focus on robust, diversified holdings. If you've made it this far and enjoying concise investing content, please give us a like and subscribe that supports our work bringing personal finance and investment content that helps you be wise. Now, within that 20% of individual stock holdings, how do you choose which stocks to invest in? Well, it's all about striking a balance between diversification and focus. You don't want to spread yourself too thin by investing in too many stocks, but you also don't want to put all your eggs in one basket by investing in just 1 or 2 stocks. It's all about finding that sweet spot. And for many investors, that sweet spot is 5 individual stocks. Why 5, you ask? 5 stocks offer a good balance. They provide enough diversification to spread out your risk, but also allow for a focused approach. You're not trying to cover the entire market. Instead, you're concentrating on these 5 businesses that you believe have the potential for exceptional growth. And you can stay on top of news, financial reporting, and additional research on your holdings. That aspect is also a requirement you should make for yourself to stay on top of overall trends, management, and competitiveness of the company. Now, how do you choose these 5 stocks? This is where the wisdom of famed investor Peter Lynch comes in. In his book, One Up on Wall Street, he advised to buy what you know. This means investing in businesses that you understand and believe in. These could be companies whose products or services you use, or businesses that operate in an industry you're familiar with. By investing in what you know, you're likely to have a better understanding of the business, its industry, and its potential for growth. Moreover, by limiting your individual stock holdings to just 5, you're ensuring that you can keep track of these businesses. You can follow their performance, keep up with industry trends, and make informed decisions about when to buy more, hold, or sell. So, within that 20% of your portfolio, aim to hold 5 individual stocks. This means that each stock would represent just 4% of your total net worth. This approach adds a layer of risk, but it also has the potential to significantly boost your returns. And remember, this is all on top of the 80% of your portfolio that's invested in diversified index funds. Also, by maintaining the 5 stocks, you'll stay disciplined by forcing yourself to sell one in order to buy an alternative. Or if you book profits or cut your losses on any one stock, you'll simply be able to hold some additional cash for when the time is right to reinvest. But what about the risk? Isn't investing in individual stocks riskier? I hear you ask. Well, yes and no. While the risk associated with individual stocks is indeed higher than that of an index fund, this risk is mitigated by the diversification of your core portfolio. Imagine your investment portfolio as a ship sailing on the high seas of the financial markets. Your core portfolio, that 80% invested in broad index funds, is the sturdy hull that keeps your ship afloat amidst the waves. It's diversified, reliable, and designed to weather any storm. But a ship also needs sails to catch the wind and propel it forward. These sails are the 20% of your portfolio invested in individual stocks. They're riskier and more susceptible to the winds of market volatility, but they also have the potential to catch a favorable wind and accelerate your portfolio's growth. Now, within this 20%, you're not just throwing caution to the wind and picking stocks haphazardly. You're carefully selecting 5 individual stocks, each representing no more than 4% of your total net worth. This is akin to having 5 sails on your ship, each catching the wind from a different direction. If one fails, the others can still carry you forward. This balance between risk and reward is what makes this approach so appealing. On the one hand, you're accepting the market return or market risk of indexing. Yet, on the other hand, you're taking a measured risk with a portion of your total net worth to boost the risk to reward profile of your overall approach. It's like being a captain at sea. You have to balance the safety of your crew and vessel with the desire to reach your destination quickly. Too much caution, and you'll never reach your destination. Too much risk, and you might end up shipwrecked. But strike the right balance, and you'll not only reach your destination, but you'll get there ahead of the pack. Ultimately, the goal is to exceed the average return without accepting undue risk. Remember, investment is not a gamble, but a calculated risk. And as with any journey, the key to success lies in finding the right balance. So, is this approach right for you? We've covered a lot today, from the importance of balancing diversification and concentration to the concept of dividing your portfolio into two parts: a core portfolio and select individual stocks. We've also highlighted the wisdom of renowned investors like Warren Buffett and Peter Lynch in choosing good businesses at a reasonable price and buying what you know. This strategy, while not for everyone, can work well for those who are willing to take on a bit more risk for potentially higher returns. It's about accepting the market risk of indexing while also taking a measured risk with a portion of your total net worth to boost the risk to reward profile of your overall approach. But remember, no approach is one size fits all. It's crucial to consider your personal financial situation, risk tolerance, and investment goals. Remember, the key to successful investing is finding the right balance between risk and reward that suits your individual needs and goals.